welcome to our BDO budget seminar. I'm Vincent Wood, a tax partner here at Baker Street. So I think the new Chancellor, Rishi Sunak, really enjoyed himself yesterday. He even got audience participation with the rousing choruses of "This budget, pause for effect, gets it done." There was a surreal air about the whole thing. He tried to address this all-sudden, all-consuming impacts of coronavirus. At the same time, he was a Conservative Chancellor announcing a £600 billion infrastructure programme, all with minimal tax increases. No wonder he seemed to be enjoying himself. And talking of surreal, it seemed a bit joined up yesterday as well, didn't it, with the Bank of England also announcing their 0.5% reduction in interest rates, all joined up on the same day. So, talking of enjoyment, our webinar today is planned to run for about an hour, and that will include some time for questions, which you're invited to send in. So, broadly, we will cover today business taxes, employment taxes, indirect personal, and transfer powers enforcement. We've got a number of speakers. But I've got the first slot. So before we get into business taxes, we thought it would be useful to just put on one slide the various measures on the response to COVID-19. So there's some of my colleagues will be covering in more detail, but there they all are. There's the £5 billion emergency fund. There's the statutory sick pay from day one, and then relaxations on medical evidence for that. For people that don't qualify, enhanced access to welfare credits. Business rates, I think that's very welcome. So the retail discount was raised to 100% for 2021, where the rateable value is less than 51k, and that's extended to retail, hospitality, and leisure generally. Business rates discount up from 1,000 to 5,000 for pubs, where the rateable value is less than 10k, and added to that an announcement of another fundamental review of business rates to report in the autumn. And just before leaving business rates, again, businesses that don't actually pay rates, for whatever reason, there's a grant of £3,000 to those that qualify for small business rates relief or rural rates relief. My colleague Matthew will be covering the next two, the time to pay and the waivers of interest, etc. And then finally, we have here the coronavirus business interruption loan scheme, which is essentially an 80% government guarantee, which is basically a free guarantee. So moving on to business taxes. So this is not the most interesting slide in that there are very few changes. As you can see, yes, we still have the lowest rate in the G20, but it didn't fall to the expected rate of 17%. I think one impact to remember is deferred tax, so there may be a requirement to revalue assets and liabilities at a high rate of 19%. And just a small comment on the bank surcharge, where there will be a measure to disregard the effects of any elections to transfer allowable losses from a non-banking company. Otherwise, no changes there. Moving on, one of the new measures relates to the corporate loss restriction. So you'll probably remember that the corporate loss restriction was introduced on the 1st of April 2017. Basically, this has worked for the last couple of years. The first 5 million profits can be fully relieved by losses brought forward, and then there's a restriction above that to 50% of the excess. So now we are bringing in capital gains. So the same basic rule applies, that from 1 April 2020, only 50% of the chargeable gains can be relieved by capital losses brought forward. And then that £5 million deductions allowance, you only get one of them, you get one of them per group, and that's now shared not only between group members, but also with capital losses as well. And just to mention, because we'll talk about them later on, non-resident landlords, this is one of the measures that once they come into corporation tax in April, this will apply to them, whereas previously it didn't. Intangible fixed assets. So this is a long story, which I won't bore you with, but this is a story that has been going on since 2002. And basically what's being addressed here is that the fact that the corporate intangibles rules, which basically are a tax follows accounts type regime, a bit like the loan relationship regime, that don't apply to assets created or acquired before the 1st of April 2002. And what that means is, effectively, is that one company may have similar assets with different tax treatments. So in this case, you might have an asset acquired from a third party after 1st April 2002 that is treated under the is within the corporate intangibles regime, and then you might have an asset that's transferred from a related party that is still under the old capital gains tax rules. So you have this kind of mixture, and everyone has to keep track of everything, and it's administratively very difficult. So the new rule seeks to ensure that there's just one regime that applies after for assets acquired after 1 July 2020, and so the basic change is that pre-02 assets acquired from related parties from 1 July 2020 will be taxed under the corporate intangibles rules. Where does that leave the intangibles regime? Well, I was likening it a bit to someone who buys a stately home, and it's really nice, and it's a great idea, but then they realise that it's very expensive to run, and the government realised that allowing relief for goodwill was very expensive, and they couldn't afford that, so they ended it in 2015, and then they bought it back partly a bit later in 2019, and what we have now is a bit of a mismatch, and I think there's still a lot to do, because every little tweak actually just makes things more complicated. Capital allowances. So no change on the 18% main rates of writing down allowance, which will apply to plant and so forth, and no change on the 6% special rate, which applies to integral features, non-life assets, and certain other assets. I suppose the main headline change was the increase of 1% from 2 to 3% in the structures and buildings allowance. I think the reaction to the introduction of this allowance was a couple of years ago was underwhelming, and people generally did not get excited about this. Whether this increase from 2 to 3% will make any difference, well, it's a positive step. The 100% enhanced capital allowances for plant and machinery in designated assistance areas or enterprise zones has been extended to at least 31 March 2021. The AIA stays the same. Remember, it runs out at the end of the year, so maybe watch out for the autumn statement to see whether that will change then. The 100% first-year allowance on low CO2 emission cars, zero-emission goods vehicles and equipment or gas refueling stations will be extended 4 years from April 21, so that pushes it through to April 25. And similarly, the CO2 emissions thresholds, which determine the availability of virtual allowances, the rate of writing down allowance will reduce as well. R&D tax credits. So a positive change here. Again, the RDEC, as this is known as, the rate of credit rises from 12 to 13% for expenditure after April. And for those of you that are good at maths, 9.72 is 81% of that, and 10.53 is 81% of 13%. So that's the post-tax return, because remember, these credits are subject to corporation tax. And interestingly, there will be a consultation on whether expenditure on data and cloud computing should also qualify, because what you need to do is you need to sort of list out all your qualifying expenditure, and there are very strict categories for this. So it's just a matter of hopefully widening those categories. So that's a positive move as well. As regards the the SME R&D scheme. So this is one feature of this is where loss-making companies can get a repairable tax credit of 14.5%. But there has been talk, there's proposals, and it probably will come in some form, that the payments claimed in any single accounting period should be capped according to the PAYNIC's liability for that year. So this has been deferred because they feel they need to consult further on the cap design. So that's deferred until 1st of April 2021. So that's good news as well, I think. Non-resident landlords. I mentioned this earlier. Offshore corporates owning UK property. Currently, they're under. They pay income tax. They don't pay corporation tax on the net rentals. This all changes in April when they will be brought into the UK corporation tax rules. As I mentioned before, all the rules apply, so that includes the good stuff such as R&D, and also the bad stuff like corporate loss restriction. So it's a mixed bag. There's many differences between the regime, but what was not clear at transition was how certain things would work. There was transitional rules, and one of those was pre-commencement interest. So I think these budget measures just seek to address those anomalies. But as I say at the bottom, I think the transition for some companies will be quite complicated because they've got coming into these potentially difficult rules around loan relationships, intellectual property, and so forth. And advice should be sought. Digital services tax. So this is a strange one. Is it just a threat, or will it actually happen? Well, it seems to be happening. What the problem here is that worldwide businesses are, or sort of worldwide tax authorities are seeking to cope with is the allocation of taxing rights. Now, the OECD are working on a multilateral approach. You know, that they want one set of rules that will apply, that everyone will sign up to, so it will be fair to everyone. But if you skip to the fourth bullet point, you'll see there that this applies a 2% tax on the revenues of large businesses on their sales. What types of business? Internet, those that provide internet search engines, social media platforms, and online marketplaces to UK users. So as I went through each of those, I'm sure you all thought of a particular US brand, and it's right that the US aren't happy about this. But so the negotiations go on and the thinking, but the UK are not prepared to wait. So they're introducing this from the 1st of April this year. So it only applies to businesses generating relevant worldwide revenues of more than 500 million, with at least 25 million of those revenues being derived from UK users. A group's first 25 million of revenues derived from UK assets will be exempt. And what the government says is that digital services tax will be discontinued once everything is sorted out, once the multilateral solution is agreed, but the timetable for that is very short. They're supposed to report by the end of 2020, so that doesn't leave them long. The first tax is not payable until 1st of April 2021. We're seen to be in negotiations with the US over a trade deal, so I think it's a case of watch this space, but definitely coming in as things stand. Finally, consultation on the offshore funds regime. We deal with a lot of clients in this space, and what is being proposed is a wide-ranging review of UK asset management sector and investment funds. And if you think about it, you know, they've been particularly affected by Brexit, or they will be, because if an EU domiciled fund wants to sell into the UK, or a UK domiciled fund wants to sell into the EU, they need these arrangements, they need these passporting regime, and this, as things stand, ceases at the end of the transition period. So this review will seek to look at that, covering direct tax, VAT, regulatory matters, very much a focus on funds marketed to retail investors. And the three purposes is really to protect the UK management industry, to enable funds and to encourage them to domicile in the UK, and to ensure that access to collective investment schemes is maintained post-Brexit. And consultations, the responses to that consultation will be due on 11 May 2020, and BDO will be responding to that consultation. So that's me, and now I'm going to hand over to Sean to talk about employment taxes.
Thank you, Vince. Good morning, everybody. It's been said, my name's Sean Healy. I'm a principal in our employment taxes team, and I'm going to walk you through some of the changes that were introduced yesterday, and a lot of them were pre-announced and rolled over from the previous budget. But the first point I'd like to pick up on is the changes that are now definitely going ahead to the off-payroll labour rules in the private sector. The public sector have had to deal with this for a couple of years now, but it's definitely going ahead that those employers in the private sector that fall into the large and medium category of business will also have to deal with this. Just quickly, those that are large and medium, classify that by having a turnover of £10.2 million, an average of 50 employees, and a balance sheet of 5.1 million. So you've got to meet two of those three criteria to make the large and medium category. So I imagine that's probably everybody that's listening to this podcast. What we're being told is there's going to be a light touch in penalties for any introduction of these rules, and in broad scope, they're going to require you to do three things. Identify workers who provide their services through what we term our personal service companies, categorise them as to whether they fall in what we all now know as IR35, whether they're effectively working as an employee or not. And if you decide they are, you've then got to manage that population, deduct tax and national insurance if they fall within IR35, and send what's called a status determination statement to all of your PSC population, whether or not they are within IR35. So this is going to be quite a large administrative task for businesses, and as I said, HMRC are promising a light touch to penalties, but that won't extend to the tax and national insurance that you could be liable for. One shouldn't forget either that this also extends to intermediaries and agencies that may be supplying you with people who work with you that are indeed trading through PSCs. So that's a three-part chain. You're engaging with a company to provide you some workers, and those workers are trading through PSCs. You still have to assess those individuals and issue statements to the agency and the worker. It's very complicated, and it's going to require a lot of attention to detail. So one of the key areas here is to look at how you're going to identify these people and, as I said, then assess them and then manage that risk. You're also going to have to demonstrate to HMRC that you've taken reasonable care in this process. So some employers have thought, well, we'll just take a one-fit-shop approach and put everybody through PAYE. That indeed is giving you no risk. It's increasing your employer's NIC costs, but it may not satisfy the requirement that you're taking reasonable care. At BDO, we've developed a couple of tools to manage and help with this process. Our off-payroll risk manager looks at identifying and helps with the assessment of tools, and our off-payroll tracker will manage the administrative process for you. One shouldn't forget that this also will bring the spotlight on self-employed workers and those PSCs that operate from offshore that already can present an immediate and historic PAYE and NIC risk. So this is a key area for you to get your heads around, unfortunately, and the budget did not change the planned introduction for the 6th of April. So now I'd like to move on to some basic, but probably I convinced I have a boring slide as well, and that's the detail on the NIC rate changes that are coming in from next year. One of the headlines that the Chancellor mentioned, highlighted in red here, is the large increase in the primary threshold from £8,632 a year to £9,500 a year. So this means that employees won't start paying national insurance until that threshold, and will save broadly £100 and £104 a week, £140 a year, I apologise, to employees. The rates at which self-employed people pay national insurance under Class 4 are also increasing, but because the rates are lower, their change will save them only £78. It should be noted that this doesn't change the rate at which employers start paying employers' national insurance. Those have increased very slightly in line with inflation. At the bottom of the slide there, we've also just got noted the allowance of the increase in the allowance of the employment allowance from £3,000 to £4,000, which was trailed in the previous budget statement in October that then didn't go ahead. Some other changes to national insurance that are bring along. There are some change to the way termination payments are going to be handled from the 6th of April. In broad terms, no longer will an employer be able to pay a tax-free allowance of £30,000 won't change, but currently if a payment is tax-free up to £30,000, the whole of the payment is not liable to national insurance. That's going to change from the 6th of April, so any termination payments paid after that date, you will have an employer's national insurance liability at Class 1A. There are a few headaches here about how you administer that, but the key point is that your costs of terminating an employee are going to rise. Also, for a small area of business, if you're operating sporting testimonials, again, the rules are changing there, and they're going to become liable to national insurance. I alluded to on the previous slide, the employment allowance is going to be increased from £3,000 to £4,000. It's not going to be a massive change. The take-up of that is not high, and we've got some details on our website, bdo.co.uk, which gives you some further details about the administration of that employer allowance. Finally, a new element to be introduced from April 2021 is an employer's NIC holiday for employees who are veterans, former armed service personnel, if their salaries are up to £50,000. So that's going to be a welcome incentive to get ex-forces personnel into work, to encourage employers to engage those people. So moving on, one of the changes that we hadn't foreseen but is welcome, I suggest, from yesterday's budget is some statutory sick pay changes. The full details will be released in new legislation, which is probably going through Parliament as we speak, but the key points are put up on this slide. So normally, an employer has to wait 3 days before they can claim statutory sick pay. That's going to be reduced to 1 day, so from day one they'll be able to claim. The current rate is just over £94 a week, and that's going up to £95.85 per week from the 6th of April. This is also going to extend to employees who self-isolate are going to be able to claim, and those employees who have to take time off to look after somebody who's claiming SSP. This obviously is currently a cost that employers bear, but the government has also announced measures to allow the recovery of SSP. And since the majority of UK employees work for relatively small employers, this is probably going to cover all but the very largest businesses. There are no details yet on how this is going to work operationally, but I imagine that the claim is going to be allowed per PAYE scheme reference. So if you're in a group company situation and have a number of PAYE references, the claim will be per PAYE reference because that's how SSP is administered now. But as I've said, we haven't got the full details as yet. That's also going to be limited to 2 weeks. So if people are off work and isolated separately, SSP requirements will still be there, but employers are probably not going to be able to claim. Finally, on this, there is a lot of people in low-paid employees under about £6,500 a year, the self-employed, and workers in the gig economy who similarly are going to be affected by, potentially affected and have to self-isolate. There are going to be measures introduced to modify the care allowance and other non-SSP related allowances to allow people to get some financial assistance in this area. Also, just briefly, we'll touch on the minimum wage, which increases yet again. So from April 2020, the core area of the workers over 21 to 24 will see a 50 pence increase per hour and a similar increase for those over 25. So government is pushing up the rates time and time again. And I should just comment here that we're seeing a very increased level of compliance checks on the national minimum wage issues, and there are a lot of potential areas that you need to be careful of here, a lot of administrative mistakes that can happen that can give you potential issues. Holiday pay is, for flexible hours, is going to be calculated slightly differently, and then that is going to assist with NMW calculations. And new workers have what we call a dependent contractor status, are going to be given they're going to have to be given written statements about their hours, leave, probation, etc., as set out on the slide. Don't know if that counts as a second boring slide in my presentation, but there we go. So finally, we're going to have a look at some company car benefits. Again, nothing really brand new here, just a restatement of measures previously announced. Those of you with an interest in cars will know that there's been a lot of changes due to emissions, and this wonderfully titled Worldwide Harmonised Light Vehicle Testing Process is basically going to increase the CO2 level of emissions for all cars across the world, and that's going to have a knock-on impact to the company car benefits legislation. In broad terms, that means the cost of a company car, which is calculated by reference to the list price and the emissions level, will increase. And the government has recognised that and said for 2021, it's going to reduce the rates by 2% to leave things broadly where they are, so there's no real tax saving there. And then they're going to phase that out in the following year and go back up. As you'll all be aware, I'm sure there's been a lot of focus on electric vehicles, and from company car propositions, that's going to be a big saving for those who choose an electric car, see their tax reduced to zero from 2021. So those of you looking for new company cars, electric cars are a seriously viable option if you're in the right area to get charged for them. Similarly, for hybrid cars, those that don't operate solely on electricity and have a low rate of tax charge at the moment, again, are going to have slightly better rules. So there's going to be a balance on the range of electric charge that you can drive and have a lower benefit. So certainly, in general terms, with company cars, an area to perhaps revisit your policy if that is something you want to look at. Okay, that's all I've got to say at this juncture. I'm now going to hand back to Vince, who's going to talk about some VAT issues.
Thanks, Sean. Just a couple of VAT slides. A bit of certainty here in a world of uncertainty. The registration and deregistration thresholds won't change for a couple of years. VAT on sanitary products to be abolished from 1 January 2021. And here's one where the Chancellor enjoyed himself a lot, I think, was the announcement of this new zero rate of VAT on e-publications from 1st of December 2020, applying to e-books, newspapers, magazines, academic journals, and as you mentioned, also that includes works of fantasy. So from 1 January 2021, postponed accounting for VAT will apply to all imports of goods, including from the EU. And in the very important area of environmental taxes, again, a good step forward. From April 2022, a new plastic packaging tax to be introduced to incentivise the use of recycled plastic in packaging. There's the rate, £200 per tonne of plastic packaging, will be applied if the packaging contains less than 30% recycled plastic. And finally, the tax will apply to the production and importation of plastic packaging. There we are. And now we go over to Vanessa to talk about personal taxes.
Thank you, Vince. I'm Vanessa Lee. I'm a tax partner and I lead our private client services team across the north of England. So I'll be delighted to be hopping on a train from London shortly after we finish this briefing today. On a personal tax perspective, there were unexpectedly limited announcements from the Chancellor yesterday, but I will cover the key changes. There was a huge amount of speculation prior to the budget about reforms or the potential abolishment of entrepreneurs' relief. But it would appear that the Chancellor has heeded the soundings of the Federation for Small Businesses in the proposals which he put forward yesterday. The relief has been retained in its current form with no fundamental changes to the qualifying conditions. And I thought it'd be worth just to recap, because entrepreneurs' relief broadly applies to the disposal of business assets, including those which are used in a trade, together with shares in a trading company, where the person disposing of them is an office holder or employee and has at least 5% of the ordinary share capital, which carries at least 5% of the voting rights and right to capital on winding up, with the qualifying gains then being taxed at 10%. The Chancellor's sole amendment yesterday was to reduce the lifetime allowance from 10 million to 1 million, which takes it back to the pre-2011 level. And per the impact report, reduce the cost of the Exchequer by 80%. It's worth noting that in 2017-18, the cost of entrepreneurs' relief was 2.3 billion, and from that, 43,000 individuals claimed the relief, but of those, only 38,000 of the claims were for claims below 1 million, which in turn cost the Exchequer 600 million. So this reduction from 10 million to 1 million will give a substantial saving to the Exchequer. This new limit is effective for disposals made on or after 11th of March, and it's worth noting that the anti-avoidance measures are being implemented, which are primarily aimed at unconditional or incomplete contract planning. If anybody is in that situation, I would recommend that advice is sought. The Chancellor also gave a commitment to review the Enterprise Management Incentive Scheme so as to ensure that it provides a genuine support and incentive for high-growth companies, but no further detail was provided yesterday. Interestingly also, there were no changes put forward in respect of investors' relief, and also retains a lifetime limit of 10 million. Moving on, given the publicity and lobbying around NHS consultants and GPs retiring early, combined with the impact of unexpected tax bills on pension contributions, particularly on those working extra shifts, the government has increased the level by which individuals are able to make tax-free pension contributions by 90,000. The Chancellor has increased the threshold limit, which is effectively net income before tax and excluding pension contributions, from 110,000 to 200,000, and the adjusted income limit, which is effectively an individual's net income and pension accrual from all sources, from 150,000 to 240,000. This in turn removes the issue for all but a handful of very high earners. The minimum tapered allowance has decreased from 10,000 to 4,000, and contributions in excess of this amount may still be made, but no tax relief will be available on the contribution. These changes are effective from 6th of April, and it is anticipated that they will help 250,000 individuals. Whilst these changes will undoubtedly assist high earners, it should be positively received at a time when the NHS in particular needs as much support as possible to assist with the UK impact of COVID-19. Whilst not referenced in the budget, I thought it was worth noting some fundamental changes which are looming with regard to residential property. With effect from 6th of April, there will be a fundamental change to the reporting associated with the sale of UK residential property, which may present practical challenges. From 6th of April, any capital gains tax arising from the direct or indirect disposal of land on which a residential property gain accrues will be payable and reportable 30 days after completion. Now, this is a fundamental change because ordinarily and historically it's been reported on an individual's tax return, which may well be 12 or 18 months following the actual disposal. There are on average 1.2 million residential property disposals per annum in the UK, and this is likely to create some practical challenges. In particular, the CGT must be paid on disposal, ignoring any of the CGT disposals or losses which are not subject to these rules. And this will accelerate the tax revenue significantly from April 2020. Again, more broadly, there are changes to the CGT lettings relief which will be restricted unless the owner is in shared occupancy with the tenant. And the final period of the CGT exemption for an individual's principal private residence reduces from 18 months to 9 months with effect from 6th of April, although there are specific exemptions for those who are in care or who suffer with disabilities. Yesterday, the Chancellor did announce that a 2% stamp duty land tax surcharge will be introduced for non-UK residents buying residential property in England and Northern Ireland, and this will be effective from 1st of April 2021. This surcharge is in addition to the existing stamp duty, land tax rates and surcharges, including the 3% surcharge which was introduced in 2016 for individuals buying second homes. As a result, the top rate of stamp duty land tax on residential property purchases will be 17%. And whilst not specifically noted in the budget, it is anticipated that this will apply to both companies and individuals. A potential refund may be available for those who become UK resident at a later date, but we are not yet privy to the practical details on this. And while that was the main aspects of the Chancellor's statement from a personal tax perspective, there were some obvious omissions. In particular, the publication by the all-party parliamentary group on its recommendations around fundamental reforms to inheritance tax at the end of January was not covered at all. And it remains to be seen if their recommendations and those of the Office for Tax Implications have been merely deferred to autumn. Equally, there were no announcements surrounding the taxation of non-UK domiciliaries or on offshore trusts or around family investment companies, all of which have enjoyed much press speculation over recent months. But maybe this genuinely is a budget to get things done. I will now pass over to Matthew, who will run through the proposals regarding HMRC's powers.
Thank you very much, and good morning, everyone. My name's Matthew Watkins. I'm an Associate Director in the Tax Dispute Resolution team in London. So I suppose in the area of HMRC powers and enforcement, no great surprises in the budget yesterday, but that's not always a bad thing. But anticipated that there would be some, of course, commentary on the government and HMRC's response to COVID-19. Which, again, very welcome. So to help support self-employed individuals and businesses in response to the COVID-19 outbreak, the government has announced extra resources to assist those struggling to pay their liabilities and in financial distress. HMRC will be committing 2,000 experienced call handlers to support taxpayers. This includes a dedicated COVID-19 helpline to help those in need. Support will include agreeing a bespoke time-to-pay arrangement with HMRC. This will help those struggling with cash flow issues and allow those who enter arrangements to spread liabilities over a pre-agreed period. HMRC has also agreed to waive late payment penalties and interest where businesses experience administrative difficulties contacting HMRC or paying taxes due to COVID-19. An interest-free time-to-pay arrangement is unusual, and there is also a commitment to suspend debt collection proceedings, which again is unusual and will be welcomed in appropriate extenuating circumstances. So very welcome news on that front. the area of new insolvency powers, again, this is something that we knew was coming, and we're pleased that we have this confirmed. Under the under the Finance Act 2020, HMRC will regain its status as a secondary preferential creditor for insolvencies that commence on or after the 1st of December 2020, which I'm sure some people will recall that this is a return to the position pre-2003. This means that in an administration or liquidation, HMRC will move up the rankings of who gets paid out first, jumping ahead of floating charge and unsecured creditors. This will only apply to taxes collected and held by businesses on behalf of other taxpayers. So what we mean by that is VAT, PAYE, income tax, employees NIC, CIS, for example. The rules remain unchanged for taxes owed by the business themselves, such as corporation tax or employers NIC. EBT loan charge. Now, this follows the review last year that was released just before Christmas. Again, very welcome news for the tens of thousands of individuals who are impacted by the loan charge. So a summary of those changes, the loan charge only applies to loans made on or after the 9th of December 2010, which is when we had the introduction of Part 7i TIPA, which relates to employment-related taxable loans made by third parties. The loan charge will not apply to loans made between 9th of December 2010 and the 5th of April 2016, where the taxpayer has made reasonable disclosure of the loan on a tax return and HMRC did not take action to protect that year. Now, that definition of reasonable disclosure is something that is still, I'm sure, to be argued and to be bottomed out, but we'll probably have more clarity on that when the legislation is enacted. A person without an outstanding loan balance as at 5th of April 19 can elect to spread the amount of their outstanding loan across 3 years, starting with 18-19. Again, that's going to be very helpful to those who do have financial or cash flow issues. And HMRC will refund voluntary payments already made in order to prevent the loan charge arising, including those where a settlement agreement has been reached since March 2016, March 2016 being the date when the loan charge was announced. Late payment interest will be removed for taxpayers liable for the loan charge for the period 1st of February 2020 to the 30th of September 2020, and no late payment interest will be due on payments on account from 19 to 2020, where the payments are made by the 31st of January 2021. For taxpayers who settled and paid voluntary restitution, HMRC is to set up a scheme under which it may make a refund of a qualifying amount paid and associated late payment interest, or waive a qualifying amount due under an agreement. By that we mean if a settlement has been reached with HMRC and you're subject to a time to pay arrangement, then clearly you don't want to continue making those payments if you know that you're only going to get that money back in the course of time. So, final slide from me. Now, investment to raise an additional £4.7 billion. There is a tax gap, and HMRC are charged with the responsibility of closing that tax gap. And these measures all fall under the banner of tackling tax avoidance and evasion. So, from April 2021, large businesses will be required to notify HMRC when they take a tax position which HMRC is likely to challenge. Now, large for these purposes will be where the turnover is above £200 million or a balance sheet total of more than £2 billion. The government will consult shortly on the detail of the notification process, and we expect that consultation to start in the next few months. And they estimate that these measures will bring in an additional £160 million over the next 4 years. The government has also announced a set of targeted measures to ensure that businesses pay the tax that they owe under the banner of fairness This includes measures to crack down on tax abuse in the construction industry, illicit tobacco, as well as measures to tackle the promoters of tax avoidance schemes. Again, more consultations in this area. And this is expected to raise an additional £55 million over the next 4 years. Tackling the hidden economy, there's legislation to make the renewal of licences to drive taxis and private hire vehicles, operate private hire vehicle firms and deal in scrap metal conditional on applicants completing checks that confirm that they are appropriately registered for tax. This is main objective is to make it more difficult for non-compliant traders to operate and level up the playing field with those operating legitimately. These measures are expected to raise an additional £155 million over the next 4 years. The government is also investing in additional compliance officers and new technology for HMRC. Clearly, that's a measure that I'm sure we will all welcome. Word of caution on that, of course, is that whilst the headline is going to be very popular, it's no good if these additional compliance officers are not given the appropriate training that they will require. So I'm sure and confident that they will. And the combined impact of all the measures in this space is part of the government's ongoing agenda, as I said before, to raise money and reduce the tax gap. And overall, is estimated, the ones listed here, to be £35 million in the latest HMRC annual report. That's the value of the tax gap, which HMRC is currently charged with closing. I think I'm passing over to Vanessa.
Thank you very much, Matthew. We're going to move on to Q&A. We've had a number of questions which have come through, a couple which have already been addressed during the course of the presentations. In particular, there was one query that was raised with regard to employers with less than 250 employees, but is that threshold looked on an individual company basis or on a group basis? So if they're in a group, and that might tip them over the 250 mark, which I think Sean addressed during his part of the presentation. One of the other questions which was raised was were there any changes to investor relief and the £10 million limit, which I did touch on during my part of the presentation, and there were no comments within the budget or in any of the supporting documentation to say that there would be any changes to investor relief. It is a fantastic relief. It's probably very much underused, so maybe we will see some greater take-up of it. And then one of the other aspects which has been queried, which I will pass back to Matthew, is how will a business judge between aggressive planning and normal planning?
Yeah, I mean, that is it's a very valid question. I think the issue here is, to some extent, it is subjective. We, of course, follow cases going through the tribunals. Tax avoidance is definitely in the sights of HMRC. HMRC will tell you that they are successful in 80% of the cases that get to tribunal in this area, but it's certainly very difficult. I mean, I think the advice I would give to anybody who's uncertain is to seek professional advice. Your professional advisor will be able to make a judgment call, but this is the tax is not black and white, and certainly the line between evasion, avoidance, tax planning, aggressive tax planning is certainly a blurred one, and one that is not getting any easier to define.
Thank you, Matthew. And we've there's one final question that we've probably got time for, which Vince will address, and then hand back over to Vince just for final comments. But given the change in the main rate of corporation tax from 17% to 19%, just how companies should be addressing that from a deferred tax calculation perspective?
Okay, thanks, Vanessa. I'm going to give a definitive answer on this because each situation will be different, but generally it is a fact that the 17% rate was or has been enacted and generally any change to the rate isn't relevant until it has been substantially enacted. So it is unlikely that the 19% rate will be substantially enacted for a while. So I think what that means is that the actual deferred tax calculations for, say, a 31 March or in 31 December 19 year end may not be affected by this, but certainly disclosures will probably be necessary or may be necessary. So I think the answer is, as I said, I'm loath to give a definitive answer, but and talk to your normal BDO contact on this, but I think that's how it normally works. So just back to a wrap up, I think, as Vanessa says, I think that the government have seem to have reserved some potential major changes to the autumn. So I think that anyone who's worried about potential tax rises, I don't think we're quite out of the woods yet. But we'll see what happens in the autumn. So that's it, and thanks to our presenters and thanks to everyone for tuning in. Apologies for the IT issues at the beginning, and I hope you feel that we got the budget done here, and we will be back in the autumn for round 2. So thank you, everyone.